Hi class. Today's lesson, what we're going to be doing is we're going to be looking at objectives 1, 2, and 3 for chapter 2. We're going to begin with chapter 2 in our cost accounting course, and what this will do is it will provide you with terminology to help you through the rest of the chapters that we're going to be completing. So I've created an Excel spreadsheet for you, and I'm going to share that with you in just a moment. So hold on just a minute and let me get that pulled up for you. All right, you should be able to see an Excel spreadsheet that I've prepared for you. I've done some notes that I think are important for you to know before we actually start the accounting problem. So we're just going to be talking about terminology today. And one of the first terms that we need to talk about is what our textbook refers to as a system. And a system is basically a set of interrelated parts that are going to perform one or more process to accomplish specific objectives. What we're going to be learning about in cost accounting is a cost accounting system where we're going to be tracing product cost, and we're also going to be tracing cost to activities. So you kind of have to understand that a system is really a broad set of interrelated parts that we're going to use to help us to obtain our objectives. One of the main objectives of an accounting information system is to provide information to the users of the accounting information so that they will be able to make good decisions about the company. And so in this chapter, they have defined for you what an accounting information system is. And really, this is a system where we're going to input economic data into a system. We're going to analyze that economic data through what we call business transactions. You'll remember from your other accounting courses, we start by analyzing business transactions, and then we're going to record those business transactions in a journal. And then from there, we post to the ledger accounts where the information is further summarized so that it can finally be reported. So an accounting information system really consists of inputs, which are business transactions. And these inputs or business transactions are going to be processed. And process means that we're going to record these transactions in the journal. We're going to put them in a ledger. We're going to summarize the information in the ledger. And then finally, we're going to report this information as output. And usually it's in the form of financial statements. But for cost accounting, we also do reporting for budgets and special reports, any kind of report that management wants. We're going to be providing to our management so that they can make good decisions based on this information. So there's a general overall accounting information system, which you've learned about in previous accounting courses that you've taken. Then what they do is they break these main general accounting information system down into two subsystems, which we're going to call financial accounting and cost accounting. And financial accounting is what you studied in ACC 120 and 121 and 122. Financial accounting basically is information that we're providing to people who are outside of the company to make decisions based on the information that we report. These users of accounting information that are external users are people that might be investors that would be interested in taking some of their cash and investing in our company so that they can make a profit off of their investment. And creditors might also be interested in financial information, financial accounting information. So our bankers, people who are giving us loans would certainly be interested in the financial information. And we call this financial accounting. Cost accounting can serve both external users and internal users, but mainly its uses for internal use. So in other words, cost accounting are going to be reports that we make for management. They're reports that would be important for employees who are internal users to help them to make decisions about the company. So for management, we're going to want to look at planning and controlling the company. And so we're going to use cost accounting reports to help us to make decisions about planning and controlling for the company. Employees would probably be interested in how well the company is doing, just so that they can be assured that they'll have a job, or they may have some of their earnings invested in retirement for the company. So they too would be interested in the company from an internal point of view. But cost accounting reports are basically used for internal users, although there is some overlap, and of course management would want to look at external financial statements such as the income statement, the balance sheet, in order to help them to make improvements to the company and also help them to make better decisions about how to run the company. Cost accounting then can actually be separated into two main purposes. And as you know, this course is cost accounting. This is definitely something that we're going to be learning about. The cost accounting information system is going to show us how to assign costs to products. The other purpose of cost accounting is for operational control information system, which is basically that we're going to be interested in how well our management is performing. And so we're going to look for feedback concerning the performance of management. In planning and controlling the operations of the company, we also want to make sure that management has the needs of customers in mind, and management should always be looking for ways to continuously improve their products and profitability of the company. So there are two purposes of cost accounting. One is to assign a cost to products, and one is to provide feedback for management so they'll understand how they can better operate a company. Another term that they mention in these first couple of objectives of the course is what we call a value chain. And a value chain is just a set of activities for products and services that are sold to customers. And a value chain can have activities that will help us to track information and to be able to assign costs to our products. A value chain activity would start with some type of research, design. You want to be able to develop or design a product. and then you're going to want to produce that product, and then you're going to want to be able to market that product so that we can sell it. And once it's sold, we want to be able to deliver that product to our customer. And then after the delivery of the product, we want to make sure that we still offer customers some avenues to where if there's a problem with the product that we've sold them, then we will want to make good on that. So we'll offer them post services after the product is actually sold. And so a value chain has these types of activities that are used basically to help us to track activities, to assign cost to these activities, and that's what a cost accountant does. Also, they've defined for you some terms that you may already be familiar with, and so we're going to review these terms. One of the terms is what we refer to as a cost, and a cost is the cash or the non-cash assets that we're going to sacrifice for goods or services that we are producing for the company while we are producing the revenue for the company. So a cost is just a sacrifice of cash for goods or services that we are using while we are producing revenue. An expense is also a type of cost that was used in producing revenue. You're familiar with lots of different types of expenses. Our expenses are going to be found on the income statement. A loss is also a type of cost. It's treated like an expense. It too is found on the income statement. But the main difference between a loss and an expense is that a loss is just a cost that expires without producing revenue. So for an example, you might remember from a previous chapter where we would sell assets. If we sell assets for less than what their book value is on our financial statements, then we sell these assets at a loss. And so a loss really doesn't have anything to do with our producing a product or producing revenue, but a loss is a cost that could happen to us without producing the revenue. So it is still considered a loss. It's treated like an expense. It's got a debit balance, and you'll find it on the income statement, but you'll find the losses in other items because it is the cost that it will expire without producing revenue, whereas an expense is a cost that is used in producing revenue. And so usually we list our expenses first. You might remember your major expense in a merchandising business is cost of merchandise sold. It's upfront because it's a major type of expense, or you might remember operating expenses where we showed selling and administrative expenses on the income statement. A loss would be in the separate category. It would go in the other items on the income statement. Also, they mentioned that assets are a type of unexpired cost. And we know assets as assets that are things of value that we will show on the balance sheet. The assets are the unused portion of the expenses, so therefore they're going to show up on the balance sheet. And the main difference between a cost being classified as an asset or an expense is the timing. You might remember we have machinery, and as we use machinery, it depreciates. And when it depreciates, it becomes an expense. And you might remember that accumulated depreciation will reduce the cost of the equipment on the balance sheet. And so a depreciation expense will result from the timing or the wearing out of an asset over a period of time. And so the main difference between a cost being classified as an asset or as an expense is in the timing of that account. When we buy an asset, we call it an unused asset, we put it in the asset accounts. Once it becomes used, then it becomes an expense. So in timing, our assets can become expenses once they are used. Something that we're going to be looking a whole lot at in cost accounting is what we refer to as a cost object. And there can be many examples of cost objects, but mainly our cost objects that we're going to be talking about in this class will be our products. We could also use customers as a cost object, departments as a cost object. We're also going to be talking about activities as a cost object. But basically, cost objects are anything that you want to assign a cost to. And so we're going to be talking about assigning cost to products. We're going to be assigning cost to activities as we go throughout this particular course. An activity is also a cost object, and it is actually a unit of work that's performed within an organization. So some examples of activities are setting up equipment. There are going to be costs associated with setting up equipment, and we'll need to be able to account for those costs in the future. But an activity can serve as a cost object. So setting up the equipment could be considered a cost object. Moving materials is also an example of an activity that we would assign cost to. Moving materials is transporting materials from one place to another place where they are going to be converted to the finished product. But moving materials can be a cost object, and we want to assign cost to those materials that are moving throughout the process. Purchasing parts, billing customers, inspecting products, all of these are examples of activities that we can assign cost to. And if you've noticed, on each one of these, there's ing on each one of them because they're actually verbs that we are looking at as describing the actual activity. So setting up an activity, moving materials is an activity, purchasing parts is an activity, billing customers are activities, inspecting products are activities. And we're going to learn how to assign costs to these activities in a later chapter. We won't be doing it in this chapter 2, but we will be discussing it more in chapter 4. It's very important that we are able to assign costs accurately to our products or our activities, because if the costs are distorted, they can make management make poor decisions that can be costly to the company. So it's very important to understand the relationship of cost to cost objects so that we can get the cost assigned accurately. And a part of this is what we call traceability of cost. And basically, we can take our cost and we can break them down into 2 different types. One of the types of cost that we can assign cost to are our direct cost. our direct costs are actually traceable to the cost objects. Some examples of direct cost would be like your direct materials that would go into the product itself. These are considered to be direct cost. Direct labor is also an example of a direct cost because it can be traced to the cost object. Direct labor is the labor where the actual employees that are working on converting the materials to a finished goods is assigned a cost. So direct labor is a direct cost, and it can actually be traced to the cost object. And because it can be traced to the cost object, we're going to assign costs to our direct materials and our direct labor. Our direct costs are going to be traceable to the cost object, and we're going to assign costs to our products based on these direct costs. Indirect costs are not traceable to the product itself. Some examples of indirect costs are factory overhead cost, or in this textbook, they just refer to them as plain old overhead. Factory overhead cost would be the cost of factory supplies. It might be the cost of indirect materials or indirect labor, or any cost that's associated with the factory will be considered to be an indirect cost, because most of these costs are not directly traceable to the product itself. Also, indirect costs have a lower cost associated with them than a direct cost does. Your direct materials and your direct labor are going to have higher cost associated with them than, let's say, indirect materials, which is considered to be an indirect cost, or indirect labor. So indirect costs usually have a little bit less cost associated to them, and so therefore we just throw them in the overhead cost category. Now, in this textbook, they really stress that there are two assignment methods for tracing cost to an object. One of those assignment methods is direct tracing. The other one is going to be driver tracing. We'll talk about direct tracing first, but both of these, direct tracing and driver tracing, both result from cause and effect. In other words, a cost is going to occur because an activity has happened. That activity is going to cause the cost. And we call these direct tracing and driver tracing results of cause and effect. An example of direct tracing is direct materials. Direct materials are tangible. That means we can touch them, we can see them, we can feel them. They can be traced directly to the cost object, usually by physical observation. They can be seen in the finished products themselves. So direct materials are traced through direct tracing. We can take those costs and assign them through direct tracing because materials can be traced directly to the cost object, the product, and usually we can trace those by physical observation. They can actually be seen in the finished product. As an example, I've given you if the cost object is a product and the product is the wooden guitars, the wood used in the manufacture of the guitar can be seen in the finished product. It is therefore accounted for by direct tracing. In other words, our cost object of the guitar is the guitar in this case, and our direct materials, wood, can be traced to the guitar. It can actually be seen in the finished product, and so therefore we call that direct tracing. Another example of a cost that uses the method direct tracing is direct labor. That's the labor paid to the people who are actually physically working on the cost object, the product. Their labor can be traced directly to the product. So direct materials and direct labor are traceable types of cost. An advantage of a direct tracing is that it's more accurate than other cost assignment methods. The benefits accuracy of using the direct tracing method will outweigh the cost of using the direct tracing method. So it's more accurate, and so therefore that's an advantage of direct tracing. The other method that we need to talk about is what we call driver tracing. It's another method where we can assign cost through activity cost drivers. These drivers are things such as the number of machine hours, the number of orders that we've taken, the number of engineering hours, the number of employees, the number of setups for equipments, the number of moves. These are all examples of activity drivers. Now, driver tracing is less accurate than direct tracing, but it's better than what we're going to talk about in a few minutes, that we call allocation. Driver tracing is more costly than any of the cost assignment methods. So that's a disadvantage of driver tracing, but it is used in activity-based costing, and we're going to talk more about that in chapter 4. So driver tracing has to do with the number of machine hours that are driving the actual activity, or the number of orders that are driving the purchasing activity, or the number of engineering hours that is driving the cost of our engineering. So driver tracing is more costly. It's a little bit harder to do, and so therefore it's something that is you're going to have to really think about when you are tracing, when you are doing driver tracing through activity-based costing that we're going to be talking about more in chapter 4. There is a third method of cost assignment which we need to talk about, which is called allocation. You are familiar with allocation of things like factory overhead. Allocation is used for convenience or the assumed linkage of the cost to the object. It is not based on cause and effect like direct tracing and driver tracing. It's based on allocation. So if you remember in previous courses where we talked about determining a predetermined factory overhead rate, that factory overhead rate was based on things like direct labor or machine hours. And the factory overhead was allocated based on a formula that we used to do that. And so examples of costs that can be allocated are factory overhead costs, such as indirect materials, indirect labor, or other factory overhead costs. We did some of this in managerial accounting, and we will be reviewing that again. Allocation has its advantages. It is simple to do and it's least expensive, but the disadvantage of it is it's not as accurate as assigning cost to our products as direct tracing or driver tracing methods are. Allocation is used, however, for external reporting purposes, even though it is not as accurate as other methods. So the three methods are going to be direct tracing, driver tracing, and allocation that we're going to be used to assign cost to our products or our activities. The next thing we need to talk about are product and service costs. Product or services is one of the most important cost objects of the organization. So we're going to be assigning cost to products, or if it's a service type of business, then we're going to assign a cost to our activities or our services. And these are cost objects that we will be looking at and assigning cost to throughout this course. Tangible products are the goods that are produced by converting your raw materials to finished goods. Raw materials are your direct materials that we place into process, and when we convert them to finished products, these become tangible products. And usually with tangible products, we're going to have to store them somewhere. And there's some storage costs that are going to be associated with tangible products. That is, if we're in a traditional manufacturing environment where we are producing the products before we have them sold, we're going to have to be able to store them. We're going to have to assign them to places where they can be stored, to merchandise inventory. We're going to be assigning costs to our merchandise inventory or our product that we are producing. But products are cost objects. Services are the tasks or the activities that we actually perform for our customers. And services are treated a little bit differently because services are not tangible. They are intangible. The buyers of our services can't really see, feel, touch, or hear the service before it is bought. It's just an activity that we provide for our customer. And so we're going to have to assign cost to those activities if we're a service type of business. Services cannot be stored. They are perishable. And so we won't be able to store a service like we would a tangible product. Services are perishable. Also, you can't really distinguish between the producers of services and the buyers of services. They got to be in direct contact with each other for the service to actually take place. And this is what we call inseparability. So services are intangible, they are perishable, and they are inseparable, which just means that the company that produces the services and the customers of the company have to be in direct contact for an exchange to take place. So these are a few of the terms that they introduce to you in objectives 1, 2, and 3. I want you to be sure that you read objectives 1 through 2 and 3 in your textbook. And I've provided a link for that for you in Blackboard. And that link is under assignments. So when you go into Blackboard and you click on assignments, scroll down to the bottom of the page and you'll find your reader in the assignments that is located on Blackboard. And that reader, if you'll click on the link to it, will take you directly to your chapter so you can read it through the e-text. Or if you've rented a copy, of course, you have a copy that you can read. But I'd like for you to read objectives 1 through 3 first. And then I will be talking in another video about how to assign product costs for external financial reporting, and we'll actually be doing a exercise the next time that we meet. And so I want to stop here, and I will see you the next time. Bye-bye.